A 41-day government shutdown finally broke, and that single event triggered a sharp rotation out of growth. Let's get right into the day-by-day breakdown of what moved the price.
All right, let's look at the weekly tape for November 10th through the 14th. The S&P 500 up 0.8%. The Dow up 1.2%. But look at the divergence here. The Nasdaq fell 0.3% and the Russell 2000 dropped 1.1%. The 10-year yield fell 5 basis points to 4.45, and the VIX closed down at 19.5 after a key rejection at the 23 level. Now you need to understand, this price action was driven almost entirely by one political catalyst, not economic data.
So let's get into the chronology of the price action. To really understand this rotation, you have to look at how the week started, which was with peak uncertainty, and how it ended with a very clear shift in leadership.
Monday, November 10th. The week opened with the market pricing in maximum uncertainty, and the reason was simple: the shutdown.
You had investor sentiment sitting at extreme fear levels. The S&P 500 was testing critical support right at 4650, which was also its 50-day moving average. Now, the driver for all of this was the 41-day government shutdown, which meant the key October jobs and inflation data from the BLS was delayed. And that lack of data, well, it made the Fed's December rate decision a total coin flip. The market was pricing that risk in, plain and simple.
Okay, so on Tuesday, November 11th, the broad indices were still holding those key support levels, but we started to see cracks appear. There was sector-specific stress showing up, and it was tied directly to the legislation being debated.
So here's what happened. Reports came out citing Politico that the funding bill was going to exclude extensions for the enhanced ACA subsidies. Well, that created a direct headwind for the big health insurers. Think United Health and Humana. They saw immediate and significant selling pressure. It's a textbook example of divergence. You have one single sector getting hit hard by a specific policy detail, while the broader S&P 500 is just chopping around holding support. And then came Wednesday, November 12th. This was the day we got the catalyst, the one event that shifted the entire narrative for the week. Midday, the news hit the tape, citing Reuters. A bipartisan group of senators had a deal. They were going to pass a continuing resolution, and that meant there was a clear path to finally ending the shutdown. This was the de-risking event the market was waiting for, and it immediately flipped the psychology.
So what happened next? Thursday and Friday saw the aftermath. The resolution unleashed an immediate relief rally. But the really important thing to watch was the rotation. It was clear and it was aggressive. Let's put some numbers on it. Over Thursday and Friday, the Dow Jones tacked on 412 points. The S&P 500 decisively reclaimed the 4,800 level. Now, for those of you who track options, you know that's a key zero gamma threshold. It's where dealers who are short gamma are forced to buy futures to hedge as the market rises, which can pour fuel on the fire. So with that political risk gone, the market's focus shifted immediately.
Okay, so now that we've walked through the timeline, let's distill this down to the core drivers. What were the big themes that really explain this price action?
It really breaks down into 3 steps. First up, political risk just evaporated with the shutdown deal. That took the main source of indecision right off the table. Second, and this is the crucial part, the focus immediately snapped to the consequence of that deal, a Federal Reserve that is now completely data blind. They're heading into a live December meeting without the official October jobs or CPI reports. And third, that new uncertainty is what triggered the rotation. Capital moved out of high beta growth and right into defensive leadership.
All right, let's talk about volatility and the options market, because the vol market gave us some really important tells this week. It showed us that fear was there, yes, but it was contained.
The key level to watch was 23 on the VIX. We saw a spike up to that level intraday, but it was decisively rejected. The VIX closed the week back below 20. Now, that failure to hold higher levels, that was a critical signal. It told you that while there was fear on the headlines, there was absolutely no systemic panic being priced into the options market.
So what you had was a classic divergence between implied and realized volatility. Implied vol stayed elevated because the shutdown was a binary yes or no risk, but the actual day-to-day market movement, the realized vol, was pretty contained. Essentially, the options market was positioned for a resolution, not a total breakdown. So the moment that resolution was announced, implied volatility got crushed.
Okay, now for what I think is the most significant takeaway from the week, the sector rotation. It was clear, it was aggressive, and we need to break it down.
And this chart just puts it in black and white.
You're looking at the weekly performance of the healthcare ETF, XLV, and the financials ETF, XLF, stacked up against the tech-heavy NASDAQ 100. The outperformance is, well, it's stark. It's a crystal clear picture of an aggressive move out of growth and into value and defensive sectors.
And this wasn't just random buying. This was a targeted reallocation of capital. Look at healthcare, the XLV. It broke out above a multi-month resistance level as money chased those non-cyclical, inelastic demand characteristics. Then you have financials, the XLF, showing real relative strength as it heads into November, which is historically its strongest seasonal month. And at the same time, you saw the former tech leaders showing clear weakness. It was a textbook flight to safety over high beta growth.
So what's next? With the shutdown in the rear-view mirror, the market's focus now pivots entirely to the economy and, more importantly, how the Fed is going to react.
There are 3 things on my radar for next week. First, NVIDIA earnings on Tuesday after the close. That's going to be a huge bellwether for the entire tech sector. Second, we have the potential release of that delayed government data. If the October jobs report drops, you can bet the market will tear it apart looking for any signs of weakness. And third, keep an eye on any Fed speakers. We've got Governor Waller on Wednesday. Any commentary from him will be parsed for clues on how they're planning to handle the December meeting with an incomplete data set.
Which really brings us to the central question for the weeks ahead. The market moved past the political drama, sure, but it basically just traded one uncertainty for another. So the question we have to ask is this: with political risk now priced out, is a data-blind Fed the new primary headwind for this market?
Just a reminder, this content is for educational purposes only. We aggregate public sources to help you stay informed and improve your own decision-making. Always do your own research. This is not financial advice.
If you found this breakdown helpful, make sure you subscribe and turn on notifications for the weekly market update playlist so you don't miss these recaps.
And finally, this is not trading advice, it's just a market recap. Markets carry a risk. Be sure to manage your downside and verify all data.